brace yourself because the latest interest rates news is sending serious shockwaves in the South African economy. On the 20th of March 2025, the MPC, which is the Monetary Policy Committee of the South African Reserve Bank, had decided to hold interest rates at 7.5%. You might be asking yourself then, where are the shockwaves coming from? If you knew the reasons why they've decided to hold them and what is going to be happening in the near term, then this is going to raise a lot of concerns in you. And in this video, we're basically going to look at how in the near term, your personal finances, your household income, as well as your businesses, how are they going to be impacted by what is coming? So we're looking at the forecast for the near term, next year, and so forth, moving forward from where we are based on what has been reported by the MPC. Hello and welcome once again to Friday Money Matters. I'm Kenneth. This Friday and every other Friday, we give you the best in insights that concern your personal finances, financial literacy and education, and all the other movers and shakers as far as the economy of South Africa and the global economy are concerned. The South African Reserve Bank sees inflation averaging 3.6% in the current financial year, and because of that, they've decided to hold the interest rates the same. Now, remember that in South Africa, we use what is called inflation targeting, basically maintaining the level of interest rates within the band of 3 to 6%. What that basically means is that this MPC, which is the Monetary Policy Committee of the South African Reserve Bank, ensures that the general increase or level of price increases are maintained within 3 to 6%. That is the mandate that they have from the government. So, in order to do that, they use interest rates to make sure that they maintain it in that particular band. If inflation increases and towards the 6% or even above that, what they will do is to increase interest rates to make sure that they reduce demand on money, and in doing so, basically they're impacting demand on consumer goods and services, resulting in a decline in inflation. And then also the opposite is true. If the inflation goes below 3%, it's not healthy also for the economy because it discourages suppliers who basically want to follow the law of supply, which states that suppliers or producers are willing to produce more of a product if the price increases. So you want to make sure that inflation is within a particular band, in this case, 3 to 6%. Okay, another reason why they're maintaining interest rate as 7.5% is because of the level of uncertainty in the global economy. You have seen the trade wars that have erupted, basically from America being the central point of those wars. The war with China being one of the biggest trading partners of South Africa. Obviously, there are certain ripple effects that South Africa is going to be faced with because of the connection with China. You have seen also the US going to war with Canada and Mexico and all the other countries, and not neglecting the fact that South Africa is also within the crosshairs of Donald Trump and all the other efforts that Elon Musk is making in trying to bring this economic disrepute to South Africa, thereby affecting South Africa as a economic outlook in the negative, meaning that the intention or the reason or the decision to hold interest rates means that the uncertainty does not give them the right kind of insight in order to either move upward or downward. But however, according to one of the deputy governors of the South African Reserve Bank, Fundi Azibana, I hope that I'm pronouncing that correctly, he stated that although right now we're seeing that sort of 3%, 3 to 4% going to 4.5% in 2026 moving forward, uh, the current data is showing or signifying that there's going to be an upward risk towards inflation. So what that basically means is that in the long term, we are seeing inflation increasing. So if inflation is going to increase, then chances are high that the SARB is also going to increase those interest rates in trying to curb that increase in inflation. So let's look at exactly how this is going to affect your personal finances if that upward risk kicks in, and how is it going to affect your household income as well as your businesses and business performance, as well as business planning and finances moving forward. First and foremost, in currently holding the interest rate the same, 7.5% is quite a little bit high for a lot of people. So although your current payments, if you've got a personal loan and other things, they might look as if they are the same. However, changes will happen, and definitely they will happen if that inflation goes up. If it goes up, therefore interest rates will increase. An increase in interest rates will mean that if you are paying any personal debt, you've got a bank overdraft, you've got a credit card, your debt reservicing is going to be a little bit higher. So more and more of your money is going to go towards servicing your debts, leaving you with less disposable income, and this obviously affecting your living expenses and so forth. However, there's a little bit of positivity in that if you've got a savings account, and this will also work if you've got large amounts in your savings. Savings are going to be earning a little bit more because of the higher interest rates. Okay, now, according to household incomes, it depends on many people are in that household. However, if you are thinking of getting a mortgage or you already have a mortgage, it means that you're going to be paying more if those interest rates increase. This is going to put a lot of pressure on homeowners as well as future homeowners. But also, there is an indirect pressure that is going to come to tenants. If your landlord is paying more on their mortgage, obviously they are going to try and find ways to make this trickle down and probably shift that risk towards their tenants. So you have not really run away from that risk. The fact that you don't own a home, it means that you will be paying for someone else's debt, but you're going to be paying a little bit higher than you are currently paying. And then the other item that I want us to talk about is the impact on businesses. Now, a lot of businesses depend on debt in order to finance their day-to-day operations. An increase in interest rates is going to affect their ability to borrow or their ability to access to capital that is affordable, meaning that they will find themselves paying more and more or avoiding such. And avoidance of such financing means that you're left with lesser and lesser options to finance your operations. The greatest impact is going to be felt in the SMME sector, with a lot of small to medium-sized businesses depending on loans in order to service their day-to-day operations, meaning that chances of those businesses to grow, to scale up, will be negatively impacted because of higher interest rates, meaning that it's now costing them more and more to have access to that particular financing. However, these are not the only effects or impacts that are going to be felt in the South African economy and in other economies. Please do leave a comment to tell us exactly what you think or how you think this is going to affect you. the impact on your personal finances. And if you are running a business, how is your business currently faring, and what do you think will happen if those interest rates go up? For most businesses that are depending on consumer income, uh, obviously consumption expenditure is going to be negatively affected as well. What other plans are you putting in place to ensure that you deal with these changes in inflation and interest rates, especially if you are highly dependent on consumption expenditure? Having said this, it means therefore that once we know or we can predict what the future looks like, you need to then have a good financial plan in anticipation for such changes. Obviously, in the short term, if you're a business, the fact that these interest rates remain the same, your financial planning is going to be a little bit more predictable. However, because the future is so uncertain, that unpredictable financial future means that right now, when this is still something that it can be done, you need to find a way to plan for that uncertainty in the future. It's the same with your personal finances and your household incomes. Otherwise, I hope that you really enjoyed watching this video. Please continue to support the channel by commenting and also giving us a thumbs up, and also share the videos with your friends and with other entrepreneurs. Don't forget to subscribe if you have not yet subscribed to the channel. Thank you for watching. This is Friday Money Matters. We'll see you in the next video. Bye.